Okay, I think we'll get started. I'm Joe McMonagle, the Secretary General of the IEF, the global home of energy dialogue. Welcome to the IEF Expert Roundtable on the global oil refining sector. 2 weeks ago, we published a report with S&P Global, which revealed an unprecedented drop in global refining capacity over the past 2 years. And this is expected to keep product markets tight for several years. As the report highlights, 3.8 million barrels per day of distillation capacity has closed since the start of the pandemic. Today, the rebound in global demand for oil products has outpaced available refining capacity, and as a result, we're faced with tight markets, high margins, and low inventories. New refining capacity is months or even years away, so we expect markets for gasoline, diesel, and other products to remain tight at least until 2025. And the medium-term outlook for the sector is very uncertain. As electric vehicles progressively replace combustion engines, downstream demand is forecasted to shift away from transportation fuels towards things like plastics and other products. So investment will be needed to adjust to new market realities as demand patterns shift with the energy transition and fuels become even cleaner to comply with tighter air quality standards. As well as gaining insights into the report findings, I look forward to hearing from our panel today and getting their perspectives on the market outlook. But I'll hand it over to Mason Hamilton of the IEF to make all the introductions and moderate this session. So thank you all for joining us today, and I look forward to a lively discussion. Mason, the floor is yours.
Thank you, Mr. Secretary General. Good morning, good day, and good evening to those of you from joining us around the world. We're here to discuss what I often refer to as the fulcrum or pivot point of the global oil market, refining. Without refineries, crude oil is just that. It's oil and it's crude, with little value beyond heat and combustion. Without refineries, consumers would not have the fuels needed for various modes of transportation, nor a long list of the valuable everyday products that they use, like paints and plastics. Refineries are, in essence, what link crude oil to customers. As the Secretary General mentioned, the events of the past 3 years, and especially 2022 thus far, have served as a stark reminder to both the market participants and policymakers of the importance of the global refining sector and its future. So today, we've assembled a cracking good team of experts to distill things down for us today, to discuss both current markets, the future of refining, and to compete for refinery-related pun points. So today we have my colleague Allison Cutright of the IEF, Eleanor Buds, Director of Research and Analysis in Oil Markets and Downstream at S&P Global, Ben Sayad, Global Market Strategist, Lead Refining and Assets at BP, and Saad Rahim, Chief Economist at Trafigura. Now to begin, I would like to ask Allison a scene-setting question. Now, Allison, can you give us an overview of what caused refining margins to soar to new levels this summer?
Thank you, Mason. I'll try to keep my remarks short as I'm eager to hear from the rest of our guests, but I think it's important to reflect on the evolution of the markets over the last few years to understand where we go from here. So I want to take us back to pre-COVID. In late 2019, the refining industry was already fairly tight. Utilization rates were robust and product inventories were relatively low on a recent historical basis. Then COVID hit and several things happened that impacted the refining sector. First, oil product demand and refining margins plummeted as a result of lockdowns. Second, governments accelerated decarbonization policies. The Build Back Greener initiatives were a high priority. And thirdly, new refining startups were delayed by issues related to supply chains, labor, and capital. As a result, as you mentioned, a record 3.8 million barrels a day of global refining capacity was closed in or converted to other uses, such as green fuels or import facilities. This was the first time in 20 years that global refining capacity contracted on an annual basis, and it happened in both 2020 and 2021. And notably, 80% of the closures and conversions occurred in OECD countries. Most of these closures were expected to happen over the course of 5 years or so, but COVID accelerated and condensed the time frame of the shut-ins. Looking forward to the beginning of 2022, global oil demand on an aggregate basis had nearly fully recovered to 2019 levels, but refining capacity was far reduced. And as a result, product inventories that had built to record highs during COVID fell to seasonal lows, and refining margins were back at seasonal highs. And this was all before February of this year. Then we had Russia's invasion of Ukraine, which has and is spurring an unprecedented reshuffling of refined product trade routes. Russia was the largest global exporter of heavy feedstocks and fuel oil. It was exporting a total of 2.9 million barrels a day of products pre-invasion, with 90% going to the EU and US. So our speakers are going to talk in more detail about the impact of Russia's invasion, so I'll leave that there. But another driver of the current market tightness is China. And outside Russia, China is one of the few places where there's underutilized refining capacity. Chinese product exports in 2021 and the first half of 2022 were down 30% from 2019 levels. And then looking at diesel alone, earlier this year, they were down 80% from pre-COVID levels. And this is despite record high diesel prices. So China's government has been keen to cut oil product exports to ensure domestic supplies and meet decarbonization goals. And we'll be diving into this issue a bit more and talking about how things have changed in the recent weeks and what the new product export quotas mean for the global market. But thus far this year, reduced Chinese exports has been a key contributor to tight product markets. So there's been really a perfect storm of events that have led us to where we are today. And I'm looking forward to hearing from our guests on what's changed from this summer and where we're headed next. So with that, I'll hand it back to you, Mason.
Thank you, Allison. So that was a good overview of everything that's happened more or less in the first half of 2022. But as we move closer to winter, prices for petroleum products have come down in some markets. But what's changed is the global economy, the gloomy macroeconomic picture here that many have mentioned. Is that playing a role, or have physical markets loosened somehow? Or did high margins prompt new refinery capacity to come online? Well, what's been providing the recent relief, as it were? And for these sets of questions, I'd like to start with Eleanor, then hear from Saad, and then Ben, please.
Yeah, so hi everyone. I'm really glad to be here with everyone today. So just some of the pressures that Alison was talking about have eased since the summer. You had extremely high prices in the summer, and the impact of that was to lower demand. So even though Alison was talking about, in particular, diesel demand not reaching 2019 levels, there was a demand boom in the earlier part of this year in the kind of post-COVID recovery situation. So demand was high, mobility was returning, everybody was getting back out there after COVID. Aside from in China, where the situation was a bit different, but certainly in the US, in Europe, travel was returning, and this was, tightening the markets and pushing prices up really high. Then you have the impact of these really high prices, which, alongside other pressures, inflationary pressures on the economic level, kind of very, very present worries about the upcoming winter in the northern hemisphere anyway. Which is leading people to change their behavior. It's reducing demand. We've seen that in all the most recent indicators, is that the demand has really fallen back. Demand kind of growth, particularly in middle distillates, is very slack, both in Europe, in the US, in China. The recovery is disappointing there. So it's a kind of question of demand side pressure for me, that has been much reduced. And you mentioned also, Mason, the new refinery capacity coming online. So my view is that it's not a question of new refinery capacity coming online at the moment. It's not that there's lots of product now coming onto the market that wasn't there in the summer. There are new refineries starting up. There's a few in the Middle East that are on schedule, but for the moment the ramp up is quite slow. And so we're not seeing the market's flooded at all with product. In fact, what's happening is that while gasoline prices are falling, which is also seasonal, diesel middle distillate prices are not falling. There's still a very, very tense situation in middle distillate markets, despite demand falling back, because the supply is also quite low and not managing to meet the demand. So that is causing a situation where middle distillate prices are still high, and stocks are low globally. Stocks are low in Europe, the US. The supply is not managing to rebuild those stocks, which is something we would normally expect around this time of year, which means we're heading into a winter where you have uncertainties over the economy, uncertainties with inflation, pressure on high energy prices, high gas prices, high household bills, and then you have these low diesel middle distillate stocks that haven't been rebuilt in time for the winter usage. So there's a lot of tension still in the market.
Thank you very much. Do you want to build on that gloomy that gloomy outlook, Saha?
Sure. Well, I think, look, what we've had all summer across commodity markets have really been the sort of immovable object of the fundamentals and the irresistible force of what's happening with the macro headwinds. And in particular, I would boil the three macro headwinds down to concerns around the Fed hiking the global economy into a recession, other central banks, but really the Fed, Europe energy crisis, what does that mean for industrial production and demand in Europe, and China property/zero COVID policies, right? And the reason I say across commodities is because I do think that prices, or at least flat prices, outright prices, are not reflecting physical fundamental realities in many markets. Copper is a good example. It's not the subject of this forum, obviously, but to give you an example from another market, we are significantly tighter today than we were when the copper price was $10,700. It's $7,500 today, right? And you can see that writ large across a lot of these markets, because that combined then with what we've seen from the SPR releases, I would argue, has actually masked the problem that is actually unfolding, right? And so what we have seen is, if you look at crude inventories in the US, you go, okay, actually everything is fine. You go, well, no, not if you include the SPR releases, right? Similar for product inventories in Europe and elsewhere, right? I mean, diesel stocks in the US are at a 26-year seasonal low, right? So that to me tells me that, okay, yes, demand has not been as strong as perhaps we would have liked over summer, but it's been strong enough to get us to these levels, right? And that there isn't a response. And I have to tell you, from the physical market, from what we are seeing as a physical trader, diesel demand in Europe has been okay. Trucking demand in Europe is okay. I think part of it, again, that you've had some issues where the Rhine levels haven't been strong enough to get you, the kind of replenishment inland that's flattered ARA inventories to a degree. But when you actually account for that, and what we're seeing from our customers and even new customers who are kind of banding together to buy bulk and saying, look, guys, we want inventory ahead of this winter. To us, that's still saying, look, things are still pretty robust. And I totally agree with Eleanor that I think there has been a price effect, and I think we have seen that. But I do think, when we look at it, in a sense, you don't even need demand to be strong. You just need demand to be there, in a sense, given how far down we are. So I think these macro headwinds have really kind of outweighed everything else. I mean, you can just look at even the price action today. What's happening is markets are up. All of a sudden, we get a producer price inflation number, which no one really looks at, and yet ahead of the inflation number tomorrow, it's a little bit higher than people expect. Everything has come off, in a heartbeat, right? Or crude oil is off $2 within a half hour. So these are the kinds of things. And finally, on that, I mean, I should add, across all these markets, like I said, the flat price is telling you one thing, but the premiums, the ARBs, the time spreads, all of these things are telling you that these markets are tight, right? So over the last month, at the same time that the flat price came off $8, backwardation for crude went up by 60 cents, which is a huge move, right? So again, it's telling you physical markets are telling you something different from what the macro side of things is saying.
Very interesting. Ben, is there something you would like to tack on to there?
Yeah, to add on to that, I think the other thing that's changed over the course of the summer is where we were, say, in early March, before the announcement of the SPR release, and with people's initial forecast of where Russian production, both on crude and product exports, were, and where we were with the level of Chinese exports. basically all three of those have loosened. SPR announced the 180 million barrel release. Russian exports have exceeded what the market initially thought, and China did release another round of export quotas just in the last month here. All those three have actually loosened the physical market, but we continue to see, as the others have highlighted, tight refining capacity. The one thing I would add around, or two things I would add around refining capacity is, first off, the high cost of natural gas has been highlighted by all of the sort of public companies in Europe as being a drag on refining margins and therefore a potential drag on overall throughput, putting one more constraint on the global refining capacity. And then the second thing that we can't overlook is that as we were coming through 2019, and Allison highlighted that we were in a fairly high utilization environment then, we were preparing for the IMO rollout in early 2020, and then the tier 3 rollout as well in the US, the low sulfur gasoline. COVID hit, we never really saw the global refining complex operate in a post-IMO, post-tier 3 world, and we still haven't seen it with those two factors and a return to pre-COVID demand. So there's still a lot of unknown about what the refining industry is actually capable of in this new world.
Good points. Good points. So, Ben, I'd actually like to hit you with this one, and I'd like your perspective. So, as Allison and the Secretary General had mentioned, we've seen a record 3.8 million barrels a day of refining capacity closed or converted since early 2020. Dare I call it a capacity cull, as it were. But what has driven companies to close or convert refining capacities? And what makes one refinery more or less favorable than another in these kind of economic situations?
Right. So I would start off by saying refining has always been an extremely competitive business. Refining closures are not a new occurrence. In a competitive margin-driven business like refining, you really have to have as many of the sort of advantages as you can have. So an advantage location, either for crude or products, and then also an advantaged ability to make high value products at the lowest cost possible. Refiners who don't have multiple of those advantages will always be at risk of closure during margin downturns. We've seen that in the past, both with new fuels regulations when people didn't see the incentive to invest, or in economic downturns as we've seen now. So while it feels new because it's been a couple of years since we've seen a wave like this, closures are not a new thing in this industry. Since 2020, refineries have really closed for a variety of reasons. Poor configuration, poor location, leading to negative margins for extended periods during the downturn. We also did have Hurricane Ida put Alliance Refinery, actually where I started my career, underwater in the fall of last year, and it was just too costly to restart. And then there have also been, what's new about this wave is the conversion of refineries into biofuel centers. And it's that last set of closures that makes this period different than prior downturns and closures, where people can now turn an uncompetitive refinery into a profitable renewable diesel facility. If they have the right location and some of the kit on the ground, they can actually save capital versus a new build and turn an unprofitable asset into one of their most advantaged.
Very interesting. Thank you very much for that. So I'd like to now move on to a topic that Allison hit on, but that's probably one of the biggest topics of 2022, and one with major implications for the refining market is Russia. This is sort of a two-part question. First, what impact are the current sanctions having on Russian product flows? And where are those displaced volumes going? And how have refineries in Europe and the US fared in replacing the products that they used to import from Russia, such as fuel oil, is sort of my first part of my question. The second is more of a looking forward aspect. What do you expect to happen this winter as the EU-led embargo and insurance ban take place? So I'd like to hear from Saad first, and then Ben can add on.
Great. So look, I think on what's been happening with Russian flows, I think it has not been a steady state. I think as Ben said, everyone, I think initially maybe have expecting a much deeper, sharper drop in product and crude flows out of Russia. There was an initial drop, but that quickly actually was made back up. But I think now what we have seen in more recent weeks is we're starting to see an erosion of those volumes again. Now, whether that is by choice, by design from the Russian side, or whether that is customers saying, look, that this is we've introduced a lot of sand in the gears to move this product and this crude around the world, right? So 3 days from the Baltic ports to Europe, you're now going 40, 45 days, whatever it is, to other markets, right? So that's, this is a finely calibrated ecosystem. We always talk about it. There's this oil market that's developed over a century, right? You introduce this much uncertainty, this much change into it, it will start to show some cracks. And I think that is in a sense what we have seen. And what we have seen then is, the U.S. has really stepped up to the plate in terms of exports, right? And we've had record liquids exports across crude and products out of the U.S. And a lot of that going into Latin America, a lot of the crude making its way over to Europe. So the system has rebalanced a bit because the U.S. has been able to flex. But I think there are limits to that and how far we can see that. Looking beyond that, I mean, and I should just add, look, obviously, I think India and China have obviously stepped up their buying on the crude side. The product side, I think less so. Now there's a real question of, okay, how much of this Indian Chinese product is going to come back towards Europe? And is Europe going to look at that and go, well, ultimately, this is Russian crude that's turned into products? Question for another day. But to get to that point, then I think when coming out to the second part of your question, when we talk about the impact sanctions have had, I think so far we haven't really seen it yet. I think now the question is going to be, we're getting into now crunch time, right? Is the sanctions package that kicks in on the 5th of December, obviously loadings that would fall past that date. We're not there yet, but we're starting to get there, right? And I think what has now added a layer of, shall we say, complexity is the sort of the price cap proposal, right? Which I know the U.S. In particular, a number of speakers from the Treasury Department over the last couple of weeks at various public forums have said, quite outright that effectively the price cap mechanism is an escape valve to get past the sanctions on shipping and insurance and all the other maritime services, et cetera, that the EU made as part of their sanctions package, right? So they're trying to find a way, really the difference between redistribution and reduction, right? So on one, it's okay, we're just going to redirect the flows. The other, we're going to actually reduce the flows. And the U.S. is saying, well, we don't want to reduce the flows. We want to just, redirect this. But in their mind, the EU sanctions package was going to cause a reduction. So they're trying to come up with a system that allows us to still flow. I think I would be putting it mildly if I were to say that there are still a lot of questions around this, right? And I think the Treasury Department is open about admitting that there are still a lot of unknowns on this. And we are amongst, I think, many of our peers as well. We're in very active dialogue with Treasury and the U.S. government to try and say, look, let us try and be a resource to help you understand kind of the many moving parts here. Because at what point are you putting the price cap? At what point is their profit that is taken? At what point is, if you're buying it fine from Russia under the price cap, but by the time it gets delivered, it's at a higher price. There are lots of questions on this. And like I said, this concept of sand in the gears is I think a very important one, right? Because there are so many questions that come up along this entire chain, which I think you can point to one of them and say, yeah, okay, we can answer this one. For example, there was a question around Danish pilots taking, ships through the Danish Straits. Okay, well, if they were to help a Russian cargo that was sold under or above the price cap to go to China, but they help it get through the Danish Straits, are they running afoul of sanctions? That question, I think, has been answered. But again, you can think of how many points along the chain that question will come up. And I don't think that there's clarity on that yet. So ultimately, I think it's going to be tricky to try and achieve this aim of not seeing any disruption or any reduction in flows. And ultimately, I think where I struggle, and I think probably where the market is struggling, is where the price is today is where we were pre-invasion. So therefore, you're pricing less than zero disruption of any flows out of Europe. And yet, A, this is a complex process that I've just outlined. And B, there are two players in this game, and one of them sits in Moscow, right? And what happens, what we've seen on the gas side is to say, well, okay, perhaps, I sell less of this oil and I actually make more money from it, right? And that is a question that we've asked, and I think has not really been answered yet. So I think a lot more to come on this. We'll see how it actually unfolds in practice. Everything looks good on paper until you sort of, see where it actually goes.
Very interesting. Thank you very much. Ben, what would you like to add there?
Yeah, so I would start off by saying Saad did a fabulous job there of outlining where we've been and also what the risks are to the future. And I guess I would, really add just emphasis to his 2 points. One is around the rebalancing of flows, increasing shipping time, and changing just the infrastructure and traditional trade flows we built up over decades. And then the second point is his final point there about the second player sitting in Moscow. That is a critical piece that we can't underestimate. Those putting sanctions in place and those operating in this industry are not necessarily in control of what the ultimate outcome will be. And so it'll continue to ebb and flow over the next several months. And it just highlights the uncertainty as we go into winter.
Interesting. So more uncertainty in already uncertain times. Great. So going from Russia to the next market with possibly available refining capacity in a market already tight is China. Now, I believe it was about 2 weeks or so ago that China announced increased export quotas for petroleum products. How much will the increased exports from China possibly change markets or change things in the global balance in the near term and or in the medium term? Now, Eleanor, I'd like to start with you, since this is something we mentioned in our report that has changed since our report came out. And then Saad, I'd like to hear from your perspective after.
Yeah, so yeah, the announced increase for the rest of this year will definitely go some way in relieving the pressure on the market, particularly in the diesel market, which we'd already talked about being very tight right now. I guess I'd mention a few things. Firstly, when we've looked at the quotas they've announced, the volumes they've announced, and the possibility of ramping up the refineries, it's unlikely they'll be able to meet that amount of exports. We think that it will be somewhat lower this year, although they've mentioned the possibility of this rolling over to next year. So we think that's something that's quite likely to happen. And then another thing connected to the relieving the diesel tension is that diesel has actually been quite tight domestically in China recently, so they probably won't be exporting as large volumes of diesel. The markets that really need that diesel, Europe and the US kind of East Coast, are pretty far away. So that, that implies either high freight rates, long journeys, or different kind of trade route reshuffling in order for that to provide some real relief to the markets. So those are a couple of things to mention. I suppose also, China's not seeking to become a major product exporter. That's not their aim. Has not been to bring relief to global markets and to become a big exporter, but it has had a disappointing kind of GDP growth this year. So this is one way for them to respond to some internal pressure to boost the economy, increasing exports and increasing trade like that. The other point, I suppose, is that when China increases or decreases its export quotas, they have a big impact regionally on other Asian markets. So if China does export a lot more, that has an impact on refining margins in the rest of the region, which could have a lowering effect, and then may result in less product coming out of other parts of the region.
So Saad, so it sounds like help is coming a little bit, maybe from the other side, from the wrong side of the world in terms of alleviating the tight markets right now.
Yeah, no, I think just to pick up from Eleanor was saying, I think that's a critical point that we're hearing today of reports of stockouts in parts of China on diesel, right? So you're already tight, you're already in that market, and this is before we start to see any even signaling that maybe we start to get away from zero COVID, get the economy back on track, potentially coming out of the party Congress this weekend, right? I'm not in the camp of they're going to announce a big lifting of the zero COVID policies. But even if they lay out a pathway, a roadmap for Q2 next year, that is how we get there, that's a complete shift on where we have been, right? And I think that tells you that then again, that market is tight and is not necessarily going to just suddenly flood the global market while you're tight at home. Two other points, I think. One is we haven't really talked about the fact that, okay, yeah, European governments put all these SPR product volumes in the market, but that they are now asking for them back, right? So France is saying has publicly said that, and that's made the headlines, but we know that other governments are out there also saying, guys, you need to start returning these barrels. There's a scenario in which these Chinese diesel exports end up right back in the European SPR release and never actually touch the market in a sense, right? Second point on this is everyone is looking at it like, okay, well, European demand is down because there's no gas, there's no energy, therefore demand is lower. Therefore, any Chinese product volumes coming in are going to swamp this volume. Well, no, if you increase the supply, you may allow some of that demand to actually recover because this is a supply enforced demand destruction, right? I'm not saying you all the way back, but there is some flex in that system where suddenly say, okay, it's like a volume, it's like a liquid filling up the kind of the space allotted, right? Is suddenly it'll fill that space. And so to me, it's not an sort of unmitigated negative that, okay, you have more Chinese diesel exports if we even get those volumes. And as Eleanor says, we're running up pretty tight towards the end of the year now, right? To see those volumes before the end of the year. And let's not forget that, Lunar New Year is earlier this year, right? It's end of January. At some point, they're going to turn around and say, we need to start rebuilding domestic, stock or have that on hand before we go into that. So, I think a lot of unknowns there. I would make one general point on China, which is what we're finding over and over again is people go, China equals property equals China. Therefore, if Chinese property is weak, China is weak, and I'm just a seller of the whole story. And we're looking at it going, actually, outside of property, the rest of China, fine, Q2 was not great, but Q3 has certainly looked much, much better, right? And again, a lot of what we track on the metal, cement, glass, all these other things, you go, it's doing well, not outside of property alone. It's just as if you took it as an aggregate, right? So at some point, I think once that story starts to turn around, people actually look at, well, what is happening? You are actually drawing stocks in China of crude, of products, of metals, of everything else. People go, wait, okay, maybe this isn't the end of the world, right? And those three macro headwinds that I talked about, Fed, Europe energy crisis, now China, and you say, okay, well, if the Europe energy crisis a little bit is being helped by some diesel, we have enough gas supposedly to get through this winter at least, then really comes down to the Fed and what happens there, right? But these other two maybe are starting to ease up a little bit and you can start to see a little bit of relief there.
Very interesting. So, Ben, would you like to chime in on any of that?
No, I think they covered it quite well. So.
Fair enough. So let's move on to beyond the near term to the medium term and talk about more of the long-term future for refining, specifically their future during the energy transition. How have ESG, decarbonization, and other climate policies influenced business strategies in this sector and investment outlooks for refining? I'd like to get each one of your thoughts on this, starting with Ben, then Saad, then Eleanor, and then Allison, please.
So I'll start off by really highlighting, sort of building on what you said in the very beginning. Refining's always been an exciting business that is the fulcrum, as you described it, in the industry. But right now, it's truly an exciting time to be in the sector. As your report highlighted, and as we see in the industry, there is new capacity coming online, and right now we actually do have new capacity coming online in the U.S., which is a bit of a change in addition to the traditional homes of new capacity coming online in China and the Middle East and the rest of Southeast Asia. And the legacy crude oil refining business is still going to be needed for many years to come, even with the rapid addition of EVs and biofuels, as highlighted in BP's energy outlook and the BP statistical review. But the footprint will shrink as the demand begins to tail off and as we get closer to net zero and as these ESG initiatives continue to take hold. And really only the most competitive sites will have the runway to last through the entire decarbonization period. The one risk that we do have, though, is as these ESG policies take hold, refiners, building a refinery, expanding a refinery, it's a long wavelength business. And refiners may forego some of these investments, or they may take longer to make those decisions. And we still need investment, and we still need strong operation from existing refineries to bridge the transition between now and when we get to the net zero future, which has the potential to lead to higher refinery utilization in tighter markets as we transition. And, just to really highlight, the most profitable refineries in the future will be those that have a competitive advantage. That competitive advantage will change as it has over time. And it will be likely those who are integrated into petrochemicals and into refiners that have flexibility to meet the growing demand for renewable ground and aviation fuels into the future.
Great. Sahad, would you like to pick up from there?
Sure. As you can probably tell from the gray hair, I've been around this industry for a while. So the number of times I've heard the phrase golden age of refining, right, is what we keep every 2 years. It will come up. So I'm glad we're not saying that this time, but I think, and to kind of pick up something Ben said, my heuristic for this, right, when we talk about peak demand and all that coming, you go, okay, we shut the entire global economy down in March and April of 2020, right? You can't fly anywhere, you can't go to work, you can't go to school, all of that, right? We still consumed, 90 million barrels a day of oil, right? And we are not investing at a level commensurate to meet that demand right now, right? And whether that is upstream or downstream, that is the problem that we're facing, right? Eventually, yes, we will get to, I wouldn't call it peak demand. I would say more like a plateau where I think you start to see Europe, China, other places demand start to fall off, but these emerging markets start to then pick this up, right? When you look at where the biggest cities in the world are going to be by 2050, most of those places you really need to build, I would say, more of a robust grid before you're going to add 1 million, 10 million EVs to each of those grids, right? So there will be, I think, more of a switch on that. That's why we call it a transition and not a step change, right? And that's why I think you will still have this demand there. But again, we are not investing enough to meet that demand. And I think one thing that we've kind of touched on, but there's a 3.8 million reduction in capacity, but when you look at how much capacity that's come on in China is actually more geared towards petchem rather than road transport fuel, right? So I will say the EVs are moving much faster than anyone, even we who look at it very closely from the metal side, may have thought. I mean, China is producing 6 million EVs this year. That's a third of the US entire annual auto sales, right? So it's getting up there. But again, there are these shifts that are taking place and that there is this structural demand that will take some time. And I think, when we're looking at it, we're going to say, let's say we're going from 100, you'll go to 98, 95, 92, you'll go from 100 to 75 to 50, right, in terms of demand. So you won't have that step down. So you need this new capacity to come online. And for me, the ESG side isn't so much the kind of permitting regulation, although that's all part of it, right? And it's the NIMBYism and all that. But it's also, the fact that companies are not being rewarded for doing their sort of core job, right? Which is to find, develop, produce crude and turn it into refined products, right? And you look at the valuations of what has happened to the majors versus clean energy producers versus electric vehicle companies. I have this chart that I show where if you literally took Exxon, Chevron, Shell, BP, Conoco, Total, and Eni, their entire market cap in 2021 was equal to Tesla, right? And whether or not, whatever your view on Tesla is besides the point, but it's telling you the market is not rewarding them in the same way. So obviously, then if you're a company, you have a shareholder, you have a shareholder base that you're, responsible to. Then you're going to say, well, okay, then I'm not being rewarded for investing in that, and I'm going to turn it around and instead I'm going to do buybacks and dividends rather than invest in new capacity, right? So it's less ESG specific, I think. It's more, okay, what is the market rewarding you based on some of these things? And I think that's what we need to pay attention to going forward.
Very interesting. Eleanor, your thoughts?
Yeah, I mean, I agree with Sad, and I think there's a bit of a kind of divergence which has become obvious with the situation recently in terms of energy security, which has, kind of again come back to the table. I mean, this is quite a Western perspective, I'll admit, but you have the years where we've been working government policy, particularly in the EU and the US, has been, really pushing for decarbonization, particularly with policies like the Fit for 55 package announced in the EU last year, and, really reducing oil demand and pushing investment in alternatives. And then you're now coming up against a situation where we need more oil. We need the oil to keep flowing and to flow at a price that enables the economy to function. So that, you know, there's this situation has come up recently, which is kind of putting these two different I suppose dynamics against each other at the moment. But I think that in general, you know, the government and EU policies, you know, have a very strong impact on forcing emissions down because they've set binding targets, and also because there's such a strong impact on oil demand from these policies, that drives the industry to adapt as well. And then on top of that, you have the company ESG goals, which now and ever more are a key driver investment in decarbonisation. But what we're seeing is you have a lot of investments in decarbonisation at refineries. I mean, almost every announcement recently in the last, say, 3 years has involved some element of biofuels, of hydrogen production, of carbon capture. So this, you know, there is a transformation going on at refinery level, and you have some really interesting projects going on whereby it's not just, you know, so you have conversions, which we've talked about, where a traditional fuel refinery is converting to biofuels, but you also have the traditional fuel refinery stays, and it adapts to, I don't know, providing heating to the local district. It adapts to producing green hydrogen, to having carbon capture and storage. So it becomes a refinery that can supply the traditional fuels that the market still needs and still will need for quite some time. But it also adapts itself to a future where oil will become less and less a part of demand of energy use.
Alison, would you like to cap us off?
Sure, I agree with everything that's been said here, but I want to highlight one other point that we made in the report. You know, the last standing refineries will be, you know, efficient, highly integrated complexes that leverage decarbonization technologies, but survival won't be limited to the fittest, but will also require some luck. And you know, refineries that become damaged in accidents or adverse weather, or face other operational challenges are going to face a merciless cost-benefit analysis. And I think the weight of the cost going forward is going to look very different than it did 5 or 10 years ago. Now there's so much uncertainty about the future of demand, ESG requirements, or more stringent environmental policies and regulations. So the environment for investors and businesses is going to be inherently riskier than ever before in the downstream sector. And I think this underscores sort of a fragility in supply-demand balances going forward. And I think it's going to be important to keep that in mind. You know, there isn't going to be a new large-scale refinery teed up to replace one if capacity is forced unexpectedly to close, or if future product demand surprises to the upside, or if there's another unforeseen geopolitical factor that further upsets product flows. I mean, we could be in for a high-priced, high volatility future. So I think it's going to be really important for policymakers going forward to prepare by increasing and actually maintaining strategic product inventories and diversifying supplies and ensuring that they create a regulatory environment that doesn't crowd out investment.
Very interesting, very good thought. So Alison, you've actually sparked a question in my mind, and followed by some comment Ben had made. And as I look at my calendar, I'm reminded that the hurricane season in the US Atlantic does not end until November. And the possibility of a December storm is still there, even though it's out of season. So this is an open question to all of you, but in my mind, in the past, the US Strategic Petroleum Reserve has been released in response to hurricane-related disruptions, either to refining capacity or to offshore production. given that we have such tight refining capacity markets right now, if let's say Hurricane Ian had made a westward turn instead of an eastward turn towards Florida, does the SPR still maintain its sort of firepower given this situation that we're in with refining capacity? It may be able to release crude, but if there's no refining capacity to process it, what does it still serve that function anymore? And I leave this open to whoever wants to take a crack at it.
I guess I'll fill the void here and start off and say, so we have made it through this far in the season without a major storm, as you suggest. It's not unheard of to have a storm later in the season, and we are still at risk. So it is a pertinent question. When you come to the SPR, when you have a storm hit, you basically lose either upstream capacity or downstream capacity. In this sort of day and age, with recent storms, upstream capacity coming offline because it's an export market, it won't necessarily impact the U.S. With the same impact as others if you can still export the sort of Midland barrels and other out of the U.S. So you have some advantages in that the market has evolved over time. When you look at refineries that have shut in the past from hurricanes, obviously the SPR is not going to help them from a crude oil perspective. Sometimes the global industry will have to step up to replace the U.S. barrels. Really, it just highlights the uncertain and tight nature of the global refining capacity if you were to have a storm. But thankfully, we have avoided any damage to the sort of energy sector and the populations in those areas in this year to date.
Any additional thoughts from anybody on that?
I mean, look, not to harp on about this, but I think what Ben is highlighting, I think what we've been talking about this whole panel is how fragile the system is, right? And it was fragile and tight coming into this year ahead of the Russia war, right? I think we were saying that before there was any concept that there might be that disruption. And now you're looking at it going, yeah, exactly this. That if there is a hurricane that's late, what happens, right? And by the way, we are already seeing, OPEC is going to be cutting barrels out of the market. We're seeing now, okay, the SPR really supposedly ending. So if you suddenly bring that back in, do we have that? But it's such a fragile system that any sort of short, sharp shock can really shake this thing. And to pick up, I think, off of something that Allison was saying as well. When we look forward, actually, when you look at, okay, well, how do we solve this? How do we build some robustness and some kind of slack into the system? Well, we didn't do it when money was free, right? Rates were zero for the last decade or whatever, almost, right? I'm exaggerating slightly, but now we're looking at rates that are significantly higher that we have not seen since the 2000s, right? And so the same companies that weren't investing when prices were high, margins were high, and money was free, are you then expecting them to invest when all those things have changed? And I don't know. And to me, it doesn't seem like that is going to be the case.
Very fair points. Eleanor, Allison, anything to add there?
No, I mean, I think just there are some incidents that highlight the fragility of the system, not just on the crude oil side, but on products. We've seen some strategic product stock releases in Europe, in parts of Europe over this summer, sparked by, as Saad mentioned, low Rhine water levels and sparked by some refinery outages. And, from my kind of experience of following the markets for a number of years, usually events like that, kind of not huge scale events, don't spark strategic product stock releases. Usually there's enough liquidity to deal with the different rerouting of product. But this kind of just highlighted for me that the system is fragile and it's not going to take a lot to disrupt it.
So I think I don't see any hands, but I think all of our fingers are crossed for nothing bad to happen for the rest of the year or for a good long while. So that is my final question for this panel. And I would like to thank all of our speakers today for their valuable insights and contributions to this. I think we've all learned a good lot. I know I'm going to watch this recording again. Now, to finish it off, I'd like to turn it back over to the Secretary General to conclude. Joe, the floor is yours.
Okay, well, thanks so much. That was really fantastic. I think one of the main themes that I take away from this workshop is, two things. Number one is that really decarbonization policies by countries and companies trying to meet different ESG targets are really the main reasons why we're seeing the reduction in the global refining capacity. But I really want to zero in this point that Saad raised about the investor issues, and I think that's a really important point. More than just ESG. Obviously, ESG is having an impact, but as you point out, the market is not rewarding energy companies, even a combination, which is a new fact I didn't know or didn't think about. The same way the market is rewarding a company like Tesla. And as I meet with ministers around the globe and policymakers, they seem so focused on the energy companies and asking the energy companies to produce more, refine more. But I really think the focus, or now we need to bring in the investor and financial community into this discussion. And investment, I think, is just as important as new supply or maintaining, and certainly critical to maintaining supply. So I think those were some excellent points that came out of it, really giving us a lot to think about. I really appreciate everyone's insights. It's really an interesting and really pivotal moment in energy markets, and so we're grateful to have all of your insights. To everyone watching, thanks again for joining us today, and stay tuned for more updates and programs from the global home of energy dialogue, the IEF. Have a good day.